Hey everybody, it's Harry Swaminathan, Thursday morning, August 29th, and I was looking at the Google position, and on Google we do have a booked profit of 3,200. However, we need to salvage this position. So let's just look at our weeklies that we have. Now, the September 1 weekly, we have a long put, 5 contracts, that's doing very well, and we have 8 days for that. So let's take that off, but look at this weekly, which expires tomorrow. And we have a short call at 870 and a long call at 880. This long call is definitely bound to expire worthless, but as you can see with this short put and this short call, we almost made up the profit for that. Now, what we might want to do today is to move in this 870 call to the 860 call because Google's at 848. Depending on how the overall market performs, you can also see that the futures are coming down a little bit. So, 860 may be a good, good option. Let's go take a look at what that option is going for. Let's select Google. And if we look at the 860 call, um, it's going for about $1. So that's not too bad. It might reduce at the open, but what we can try to do is to sell this 860 call. So basically we're just having, we just have today and tomorrow, but let's see how the market opens before we do that. A slightly more longer term strategy, let's look at the positions again. And then if we look at our iron condor, this is what we have. The call side is fine. We got 22 days for this iron condor. Now on the call side, let's just look at the call side for a moment. We have a profit of, let's say, 4,000 right here. Okay, and we have between the net liquidation value, which is 20,000 and 13,800. So we have another 6,000 to go on this trade, on my position, of course. So 4,000 is, is we already have a profit and there is 6,000 more to go. So there's $10,000 worth of profit right here. Now let's look at the put side because that's where we are hurting. The put side, let's say 49,638. Let's say there's a loss of 11,000 right here. Okay, so there's a loss of 11,000 on the put side. On the call side, we would probably make the entire 10,000. So looking at still not too bad, a loss of about 1,000 if the markets were to, if Google were to stay right here. But what I would want to do if the negative sentiment continues, if Google continues to go down, obviously we have this long put to give us some protection for the next 8 days, but we might want to roll this over to the next month. Now, I'm not generally a fan of rolling these spreads over to the next month because you're just extending the trade and very often it doesn't pay off. But I think in this particular case, it makes sense to do a roll. So basically what we're looking at is instead of the September series, we would roll this 840, 850 over to the October series and see, we are going to book a loss of 11,000. So basically we want to get that kind of credit from the October series. So let's go take a look at what the October series might look like. So first thing I'm going to do is I'm going to hide positions. So we start with 0. Then let's go take a look at October. October's obviously got 50 days to expiry, but what we want to see is Google's at 848. So we want to go to a very safe distance and still be able to try and recover our $11,000 that we are going to lose in this roll. So let's say we go to the 770 strike price. So let's go there and sell a vertical. We do have a $20 spread, but let's see if we can do something with a $10 spread first. So we have 150 in credit. So if we did 40, that would be $6,000 in credit. Okay, so it'll be $6,000 in credit. Obviously not enough for our 11,000. So let's do the same, a $20 spread. And if we do 40 into 2.75, that will be close to, I think, 11,000. Let's see here. Yeah, exactly 11,000. In fact, the max profit on this is exactly 11,000. So now, hopefully, what we can do is if we can roll this over to the next series, to the October, we let the September calls expire, because it looks like at this point the September 890 900 is probably going to expire. Of course, we don't know, there's still 22 days. We might get a bullish push again, but if we do, then obviously our bull puts right here are going to benefit. But I think just strictly from a probabilistic standpoint, it looks like 890 900 is fairly safe. So we get to book this $10,000 profit. We'll roll this one over to October and pick up the same $11,000 that we're going to lose. So basically, when you do a roll like this, it doesn't affect your account, because whatever you lost there, you're picking up as credit. So that credit actually comes into your account right away. So we're picking up that same $11,000. And of course, if the markets do continue, we do have a long put here, which will do very well and will blunt, not just blunt, it'll create a good profit. So that's what I'm thinking for Google. Obviously, let's wait for the markets to open, see where things stand. One of the first things we might want to do is to move this short call from 870 to 860, pocket another $1,000 hopefully, and see what needs to do. So those are the two adjustments that I'm looking at for Google. Thanks.